Startups are starting to spiral down, and really, it's no surprise. Globally, the winter started in summer, and here in India, the funding taps are starting to dry as the year closes. With funding falling to a 10-quarter low, the headlines this holiday season are getting grimmer and gloomier.
Is it time to sound the bugle on an impending funding crisis for startups? Is the shine coming off?
We saw how bloated valuations led to a wipeout of investor wealth in the stock market when they hit the IPOs. This time around, there's a company called Byju's.
It seems like the gravy train has come to a halt. We've seen a wave of layoffs hitting India's startup landscape.
As we tackle what will be the first down cycle for a lot of very young founders. And of course, what's the investor playbook?
But if you thought the worst was over, think again. CEO at Flipkart, Kalyan Krishnamurthy, warns that testing times are still to come.
This is going to be a tough next year. I think a lot of people probably hit the market, is my estimate, maybe between April to June next year. And that's probably the moment of truth for all of us. Next 12 to 18 months is where we'll see a lot of turmoil, volatility.
But what will the future hold? Funding has already collapsed, dwindling down to $3 billion in the last quarter, which ended in September, which is less than half of what was received by the startup ecosystem last year in the same quarter. India's most valued startup Byju's has been schooled by one investor as it brings down the valuation of the edtech behemoth to just a third from its earlier peak valuation of $22 billion down to under $7 billion. Does this mark a severe reset of valuations as well as mindsets?
We need to have that 2008 kind of mindset where you can't count on funding 6 months, 12 months down the line. We're not Section 8 companies, so we can't be not profitable for forever.
I think if you don't realize what your true value is given the new cost of capital, and you keep pushing it out, I think that's a dangerous game to play. Valuations have to be reset. They've reset dramatically in the public markets in India in tech and in the US. That has to follow through on to the private markets. I think 23 is going to be tough. I think the companies which sort out their unit economics and have an appreciation of what's going on and realize very quickly what they have to do will be in a better position. The others who are not focused on the unit economics and not taking the tough decisions, I think will go through a very tough time.
That was Harsh Jain of Dream11 Sports and Sumer Juneja, the India head and managing partner of SoftBank Investments. So as unit economics gets tougher and the IPO market gets rougher, the entire startup ecosystem finds itself on what seems like Survivor Island, the finale season. What does the climax hold? What next after big layoffs? I speak to Pankaj Nayak of Aventus Capital as we explore, will Indian founders have to embrace down rounds in the next twist to the tail? And as the stakes get higher, will governance and principles be passed on by desperate founders? Amit Tandon of IIAS navigates us through the ethics of startup survival. It's December 1st. I'm Anupriya, your host, and you're listening to the Startup Survival Island, What Next, on the Morning Brief, brought to you by The Economic Times. It's definitely winds of change for the startup ecosystem. But will it turn into a hurricane or a storm? Well, to get a sense of the on-ground reality and funding perspective, Pankaj Nayak from Aventus Capital joins us. Pankaj is a seasoned investment banker with over 2 decades of experience and obviously has seen his share of upswings and downturns. Thank you, Pankaj, for joining us here on the Morning Brief.
Thanks, Anupriya. Thanks for having me here.
Pankaj, we just heard a few of the speakers from the ET Startup Awards that were held recently in Bangalore. You too were part of that event. There was a lot of talk of reset of valuation, conservations of cash, survival of the fittest. Give us an insider's view of behind the scenes. What is the funding scenario really looking like right now?
So look, I was there, and obviously there is always a lot of talk about, the funding winter and down rounds and cash trap companies, etc. I think you have to look at things a little differently because 2021 was a year where a lot of good companies and great founders raised quite a lot of cash. And so a lot of those companies are not coming to the market or actually have a runway of almost like 2 to 3 years. Those companies are sitting tight on a cash. There are companies who did not manage to raise cash in 2021 and also, had a high burn businesses. Those obviously have to revisit how their business models are looking and whether investors are as attracted to them or not. And those companies obviously are the companies that were closer to go to the IPO and they think that they will raise a lot of money in the IPO and will continue to burn quite a bit of capital. I think those are the companies are going back to the drawing board and we'll see some of the challenges that you mentioned. Not all the companies are in the same zone and some companies are doing pretty well and some companies have always been profitable. They are doing fine in any case.
Pankaj, I'm going to loop back once again a little bit later on what it means to really going back to the drawing board. But I want to come from the founder's perspective to the funder's perspective. What's happening to money movement at this point when you're talking to VCs across the board, angel investors? What is the sense you're getting on deployment at this point? Where is the allocation going? Is it coming in or not coming in?
Actually, that's a very good point. If you look at in later 2021, a lot of funds actually had raised India-specific funds or tech funds. Also, a lot of private equity had raised a lot of capital to be deployed in India. So there is a lot of capital that is available. The bar to invest capital into companies has, gone up substantially. Also, in 2022, most of the investors are not being questioned if they actually don't invest at this point of time. Especially the global investors whose ICs are, in the US, where their worldview is largely through the lenses of the US ICs. They are not being pushed to actually make an investment. So people are not taking calls easily to actually make the investments happen unless somebody who's been around in this market for a long time and has enough, empowerment to actually take calls. I think the rest of the people are being pushed back. Some of the late stage funds, sovereign wealth funds or, pension funds are still very, active. Private equity funds are also active. Also, the growth funds of venture capitalist funds are active, but the bar to invest into companies has gone higher. I think the people who are like less seen in the market are the crossovers or hedge funds who were looking to invest into companies and eventually enjoy quote unquote the IPO pop. Those investors are absent from the market.
Okay, so obviously at this point, Pankaj, when we're looking at some of the newly listed companies, so now below their pre-IPO peak valuations and are down a good 60-70% in some cases to their listing values, that has really hit sentiment across the board for investors and for founders that are in late stage?
You raise a very good point because when these companies went public, their pre-IPO rounds obviously were attractively priced and their IPOs were even premium to those attractively priced rounds. I mean, when I say attractively, reasonably good valuations. And then all those companies have corrected in the valuation. How does that impact private market, right? So when investors do their analysis of their return profiles of the companies that they want to invest in, they take an exit case, which is, usually a capital market exit, right? 3 years down the line, 5 years down the line. So when they're looking at the exit case, obviously the comparables in the public market are what they're going to look at. And the comparables are not trading as, the valuations that they were trading of 2021 level, then your exit multiples are obviously going to be lesser than what people would otherwise would have thought they could get. Obviously that impacts the entry valuations because your exit valuation underwriting is not at high multiples. And so that could impact your entry valuations, assuming, the return requirements remain the same, which also in some cases, because of, tightening of the money supply and obviously Fed rates have gone up, your requirement of return is also higher. So your exit multiples are lower and your return of requirement is higher. So ideally, it should have some impact on the entry level valuations. At the same time, if the companies are growing well and their businesses are performing well, then a lot of companies are possibly will get into their valuations as well by the time they actually would go to the market and raise capital. So it's the tussle between the external validation of valuation versus, inherent business and its growth.
Pankaj, you automatically bring me to my next question, the inherent valuation point. We've seen in the headlines quite recently India's biggest and most valued startup, Byju's, getting written down in one investor's book. From holding a $20 to $23 billion valuation in most investors' books is now being marked down in one investor's book down to almost $7 billion. To simply ask, how does that even work? How can there be an investment which is markedly so different in different investors' book? What does it really mean to see such big variations in valuations across the board?
Okay, look, I won't be able to comment on individual case or a company, but I can,
Sure.
talk about broadly how these things work. And then different funds actually have different benchmarks in terms of how they value their investments internally when they present to their LPs. Some people do a fair value based on the public, market comparables out there. Some people, believe that, there are no other comparables to this company. So they kind of hold on to the similar valuations which were there in the last round. And some people probably will figure out a certain way of looking at, indices going down and doing fair bit of work with respect to particular industries, multiples, how they are trading either in public market and private market, and evaluating their portfolio and their books when they present to their LPs. I think some of the companies, when they actually hold financial investments in a listed company, they probably are under more scrutiny. So they are, forced to do some evaluation and take certain calls. But it is not necessary that every fund will have to do it. At the same time, just because somebody else has done it, then you're not forced to do it as long as you probably able to kind of communicate to your LPs what you're doing is right or wrong. And that's very much a fund specific. Now, a few years ago, some pre-IPO or a public type investors have marked down their holdings in one of the large tech company in India. And we all know how it ended up later. The valuations almost doubling or tripling at the time of exit. So I'm hoping that is just a phase. People will come back with much stronger, business, and eventually people will still be in the money or make good returns on their investments.
I want to pick up on that point on down valuations, Pankaj. Globally, we've seen many examples through this year, starting with Clam, the European fintech that was once valued at $45 billion. And when they went ahead and raised money this summer, they brought it down almost 70-80% down to being a $6.5-7 billion company now. The CEO recently spoke at the Startup Slush event where he said, we knew what we needed to do because the market realities were different. And they weren't the only ones. Stripe has done it globally, Instacart has done it. So down rounds do not have the stigma globally, but somehow in India that has not picked up pace. I was looking at some data which show that in 2008 to 2014, the last massive downturn, over 1,400 companies had down rounds, and almost 90% of them showed a success rate of surviving through the downturn because of it. But somehow in India, bringing down the valuations almost becomes an izzat ki baat across the board. Do you see that changing? Do you see the down rounds becoming an actual option for founders to keep into the survival game?
Look, Anupriya, we have seen this in the past, right? In the Indian founders have taken down rounds. You just yourself mentioned all the statistics. I don't think that people have come to a fork where they have to make a decision in terms of whether to take a down round or just close the company or do anything at this point of time. Also, the third alternative that became available in 21 and to a certain part of 2022 is a structured investment or convertible bond investments, or there are high yielding convertible bond investments. Now, a lot of founders have chosen to, go and do these high coupon convertible bond investments. In my view, that's actually more dangerous than, doing a down round, because you're almost taking a debt type obligation. You're continue to pay a high dollar based coupon. And, at the same time, all those have their caps and the floors of valuation, which are ultimately are anyway capping your valuation to your existing valuation or maybe some discount to that. So rather than doing something structured and taking debt like obligation, I think people should be able to swallow the bitter pill once and for all and move on in life. If, push comes to shove at that point of time, if they have to do down round, actually people will think about it. But what people are hoping is their businesses are growing well. They have got enough time to make sure that their business metrics are well in line and their path to profitability is visible. So when they actually go to the market, their businesses will grow into their current valuation so that, they don't have to do down round. Now, when these companies will go to the market, we will figure out whether that's actually true or not.
I want to pick up on the IPO market. Now, this has been a very tough game because the retail reality of the valuations have really hit hard. We also heard Nitin Kamath talk about how now startup founders have to really think about why they want to come to the market. It can't do it for fanfare, they can't do it for the badge of honor, but really because the business requires it. So, in that aspect, what does 2023 look like? Do you think it's going to be a real litmus test for the ecosystem?
You raise a very interesting point. We actually recently had a workshop for a few of our clients where we actually had invited one of the public investors, and he raised some very good points. He said the first and the foremost is you decide whether you really want to take this company IPO or not. Because, taking the company IPO is not just, a one-time event. Corporate actions you take, what kind of guidance you give, your ability and freedom to kind of stop businesses, go acquire something, everything has an impact on, the stock price. So I think people have to decide whether they really want to do IPO or not. In last 3 years, we had created almost a $10 billion of private secondary. As compared to the total capital that has been raised in IPO, the private secondary market has given larger exit to actually the private equity and venture capitalist investors compared to the public market has given. So the option of not going public and actually the shareholding changing hands, going to the later stage investors is still available. I think that more and more people will be more disciplined about when would they want to go public and what is the reason they really want to go public. And so I'm seeing that 2023, the people who are very disciplined, their systems, and processes, that's true about existing companies that have gone public. But I'm saying that we're very clear about why do they want to go public, not because, some people on the board saying that let's go public, or, somebody wants to go and ring the bell. Those are not the motivations why people should go public. So my sense is people will be more disciplined about whether they want to go or not go.
Pankaj, it's been a roller coaster year. Now we're entering December. What's on the other side of 2023? The bigger opportunities or challenges that lie ahead?
I'm eternal optimist. So I always see opportunities. I'm saying 2022 was slow. 2023, I see actually fresh allocations to the funds. Most of our smart founders actually going to make their businesses leaner again and will be far more attractive to the investors to invest money. So that one part. Second part is obviously there will be secondaries on the private side that will happen in my view because people did not take enough capital out in 2021. People will probably go and do some private secondaries. And so I'm quite bullish about 2023 being a reasonably active year with respect to fundraising and capital changing hands. I think we will figure out at that point of time whether it's going to be at the same valuation, higher valuation, lower valuation. And it's not an answer that there won't be one answer that fit all. I mean, we are in the market, couple of companies that we are taking to market, we are doing rounds at a premium to what their last round valuation is. And not because their multiples have expanded, it's just that business has done well. So you will get all sorts of, different flavors that you will see in 2023 with respect to funding. Funding environment will be very active. That's my view.
The word on the street is loud and clear. Only the lean and possibly, given the layoffs, the mean machines will see this through. But in a bid to survive, will many founders get creative? We've already seen tales from Zilingo, BharatPay, Trell. And investors were already getting shocked by resignations and late disclosures, even in the regulated listed firms. Do guardrails and governance need to be tightened as new businesses find new ways to stay afloat? Amit Tandon, founder of India's largest institutional investor advisory firm, IIAS, joins us in the morning brief to talk about some of these red flags. Welcome, Amit.
Thank you for inviting me.
Amit, you had held a conference on governance in startups a while back and even developed a metric for some of the listed lot. What is it really showing you?
We developed a corporate governance measurement we call the Corporate Governance Scorecard. And we developed this along with IFC and the Bombay Stock Exchange. And we kind of been scoring the top 100 companies with regard to governance. And we kind of decided that, look, why don't we score some of the companies which have just got listed? And we found without fail that the companies which had recently been listed scored well below the companies which had been listed for a longer period of time. So we believe that for a lot of the unlisted companies, their focus is entirely on getting the technology right, getting market share, getting more footfalls, getting more eyeballs, whatever it is. And they're not focused enough with regard to the governance, which once you list becomes a very important ingredient and a very important input as far as how the markets view you as a company.
Before we move ahead, here's Uday Kotak, one of the OGs of the startup world at the IIS conference, on his advice to the new age founders, especially on governance.
I think governance is much more about substance than about form. Unfortunately, in recent times, because many companies have not adhered to the substance of governance, we are getting a lot of form. And the form has come in because fundamentally, the concept of principles-based regulation versus rules-based regulation has given way to more rules-based regulation, because principles-based regulation has been misused by the system in many, many cases. But I would only advise that as the startups grow, be cautious, because the tendency at times is being fast and loose with regulation. My advice would be that have an aspiration to grow, to touch the skies. But remember, the walk from planet Earth to infinity comes with many snakes and ladders. Therefore, use the ladders well, but keep in mind along the way, there will be snakes, and your ability to spot the snakes early is as crucial.
Well, Amit, one of the snakes or slip-ups in governance has been disclosures, especially when it comes to key personnel leaving startups or newly listed companies. We've seen the news coming in social media or even on official handles before it even hits the exchanges. The contentious point seems to be what is recognized under regulation is key material management and whom they need to inform about. Do you think there's a big regulatory gap that startups or newly listed companies right now are skirting?
Look, it's interesting you bring this up because SEBI's just come up with discussion paper in terms of what needs to be disclosed when. But on some aspects, there is no clarity in terms of materiality. What is materiality? Someone could say that it is 10% of turnover. Another company can define it as 5%. Another company can define it, and SEBI is now saying that it needs to be 2%. Is it disclosed at the end of the day? Is it disclosed at the end of the board meeting? Is it disclosed instantaneously? These are some of the things where there is no consensus. And therefore, in part, the fact that SEBI's kind of sent out a discussion paper and is hoping to address some of these issues, it's welcome. So the way to think about it is that, look, if there is anything which might impact the market price, it's good to disclose it sooner rather than later. The more you delay disclosing it, the more contentious the issue can become. And in this context, Narayan Murthy said that, look, if you're not sure whether to disclose it or not, it's best to disclose it. So that's a good policy to follow for companies. But again, we're talking about startups. A lot of the startups are coming from is that they've got their investors, and by that I'm referring to private equity investors, sitting in the room with them. It is the private equity investors who are driving the business or suggesting deals and then ensuring that funding is available and the deal is structured right and the deal happens at the end of it. Now, in the public market, you don't have that comfort. There are boundary conditions with regard to who you can speak to, when can you say it. So you kind of enter or walk into a completely different way of doing things, or if I may say, you're in a completely different room once you're listed. And therefore, some of the practices which are there as an unlisted entity have to change very dramatically once you become a listed entity. And some of the problem surfaces from there. Some of it, as I mentioned earlier, surfaces from the mindset which companies have. Some of it surfaces from just the unfamiliarity with what is happening.
Let's pick up the headline of the recent news of a big CFO resignation coming in from Nykaa after the botched up bonus issue. How does an investor really dissect such information, and how should one then evaluate the corporate governance of such a company?
look, with regard to the bonus issue, you can say that it was argued that it was a little bit strategic, or the fact that, they didn't come into it with clean hands. And having said so, it's very difficult for companies to kind of take into account what the tax implications would be in all instances. So here, of course, the magnitude and the scale was a little bit high. But having said so, it can get a little bit tricky. As far as the resignation of the CFO is concerned, look, I, for one, don't believe that this would have been the decision which would have been, taken by the CFO. This would have been pretty much taken by the board and the promoters. The CFO may have been he might have suggested it. He may have steered the whole conversation and the whole process forward, but he may have pushed aggressively for it. But at the end of the day, it's the call which the promoters take. It's the call which the board would have taken. So I will, at this stage, my personal view is it might be reading too much into, the resignation.
Amit, right now, as you look at the ecosystem, what are some of the biggest red flags that you're seeing?
Look, at the moment when we look at it, the biggest red flag is the charter documents or the memorandum and articles of association of the company. What is happening here is that there are certain rights, be it to the founders, be it the promoters, and most of them call themselves founders and stop being classified as promoters. So let's use the word founders for the remainder of this discussion. And for the private equity investors, get embedded in the charter document. So it will say that, look, the private equity investor will sit on the audit committee. Certain decisions will not be taken if the nominee of the private equity investor is not on the board, attending the board meeting. Or you could turn around and say that, look, so-and-so is the founder and they will have a right to, appoint the CEO and one other member of the board as long as they continue to hold a predefined amount of the equity. Now, these are certain rights which we believe, and certainly for the private equity, more so for the private equity, but also in the case of founders, which we believe should drop off the moment the company is listed. The company's got listed, the private equity investor has a choice of exiting the stock if they want. They've chosen not to, but they're kind of still sitting there and acting as people who still are in control and are driving the process. That, to my mind, doesn't apply once you've kind of got listed. You're there by choice. You could have sold the shares. Therefore, that is one area of conflicts which we see, and which is why you have some amount of, I would say, creative tension between how the public market investors are behaving and how some of the private market investors are behaving.
This creative tension that you talk about, Amit, I want to extend that further when it comes to the problem points with irrational compensation, especially via ESOPs. There seems to be a nexus between the big investors when it comes to rewarding the CEOs, even after the company is listed. How do you read into it?
The private equity investors may have got their returns, and therefore they're happy to reward the CEOs or the founders by giving them ESOPs, which can be at par. But today, if the equity is listed, it's very difficult to justify why shares should be, or ESOPs should be converted at par if the share price is 100 rupees or 150 rupees. It's very difficult to justify why it should be 10 rupees. And the fact that, it kind of gets converted to equity for just showing up at work. At the very least, if you're kind of looking at ESOPs at such steep discounts, then it should be linked to certain targets, which is that the company will be profitable, the company will start declaring dividend, or the company will grow its market share. So there should be some tangible measures on account of which these ESOPs get converted at the steep discount that they are getting. But at the moment, what we are seeing is the private equity investors, having made a truckload of money, are now happy to ensure that the promoters themselves kind of partake in some of these benefits. As public market investors, there's very little buy-in for. So if you kind of look at these resolutions which come up for voting, you find that a majority of the public market investors vote against the resolutions, but because the private equity is there, they hold a large chunk of the equity, they support the resolutions and they get carried. So that again is an area of some friction.
Amit, what about related party transactions? There have been some concerns that have been raised where new companies have had related party transactions, brothers of wives and founders and friends. Is the governance of this falling through the regulatory gaps right now?
As of now, we've not seen enough instances of related party transactions, but we'll have to wait and watch and start to see some of it. Some of it could be just the way it was structured. Some of it could be regulatory, like a payment bank, and the ownership of a payment bank has to be different for an individual and a company, and so on and so forth. So some of those are regulatory challenges, and some of these related party transactions, investors will have to kind of accept and hope that there are sufficient checks and balances or engage with the company to ensure that they're not egregious or it's all within certain boundary conditions. Else, they'll have to find ways of unwinding some of these structures to ensure that there is smooth sailing going forward.
Downsizing to down rounds to dodgy decisions. It is a power-packed finale for the startup edition of Survivor Island. From fast and loose to cautious and miserly, the tune on the soundtrack for startups has seen a genre shift. But as Pankaj pointed out, it's not all gloom and doom. Cash may be coming in sparsely, but war chests were filled over the last 18 months. So tough, brave, and hopefully ethical decisions will be made, and that will separate, for the lack of a better phrase, the boys from the men. The countdown begins now as we kick off December. But before I sign off, on a programming note, a very special episode drops tomorrow on Friday, where my colleague Kiran Somwanshi discusses disability inclusion in the workplaces, the chances and challenges ahead. With that, it's a wrap from me, Anupriya, and a big shout out to the team that helped put this episode together. On sound, Indranil Bhattacharjee, who's done wonders despite my sore throat, producers Sumit Pandey and Vinay Joshi, and executive producers Arijit Burman and Anirban Chaudhary. Remember to follow and like our podcast on the platform you choose to hear us on. Thank you for listening in.